Okay, and we are live. Welcome to CCIM San Diego's Lunch and Learn series, where we promote excellence, competency, and collaboration. A little bit of background noise, but that's okay. We'll work through it. I'm your host, Doug Tabor, CCIM, board member of CCIM San Diego, and rental property realtor with Keller Williams KW Commercial. Of course, my co-host this morning is Ms. Paris Moe. Paris is a sustainability coordinator at Verdani Partners. How are you today, Paris?
Doing great. How are you, Doug?
I'm doing fantastic. You look like you're in a ski lodge, so hopefully you're going to spend the rest of the day hitting the slopes.
Yeah, that's the dream.
Wonderful. All right, a few housekeeping items. As attendees, you are in listen-only mode, but of course, you're welcome to chat amongst each other through the chat box. We absolutely encourage questions. In fact, Jordan, our speaker today, said he wants all of the tough ones, so let's give him those. But again, we ask you to use the Q&A box to submit all of your questions. And of course, as usual, this webinar is being recorded and you will get a link to the replay after the event. So here is our agenda. We are going to open with some recognition of sponsors. Sorry, it's on the other screen. We're going to do an audience poll, find out who's with us today, introduce the speaker, and then Jordan's going to come on and give us a wonderful presentation on Proposition 19. About halfway through the hour, we're going to open it up for questions, and then we should be wrapping up right around 1 p.m. this afternoon. Okay, a little bit about CCIM. If you don't know, CCIM stands for Certified Commercial Investment Member. The CCIM lapel pin denotes that the wearer has completed advanced coursework in real estate economics and investing and has compiled a portfolio of proven experience in the industry. Membership is made up of commercial real estate professionals from across the globe. And the San Diego chapter focuses on hosting events like this one that promote excellence, competency, and collaboration. And we've really made it a point for you to find information about CCIM in a number of places. One of them is our new CCIMSandiego.com website. Take a look at that for some information. Connect with us on our LinkedIn page, and certainly go over to our YouTube channel and subscribe. We have a lot of content on there. We're obviously adding more. Every time we do one of these videos, one of these events, we add it to those channels. So certainly subscribe. And if you have information about becoming a CCIM designee, definitely go over to the website or contact one of us, and we'll certainly be able to help you go down that path, which is a great way to learn more and more about commercial real estate investing. And then at this time, I'd like to take a quick moment to really recognize our generous sponsors for 2021. Our platinum sponsors this year include Hex Sahlberg, Marcus and Millchap, and Savills. Our gold sponsors are CoStar, Exeter 1031 Exchange Services, SCS Engineers, and Slat Capital. Of course, we thank all of our sponsors for your continued support, especially in 2021. Now that you know who we are, we'd like to take a moment to figure out who is watching today. So if you would, please take a moment to fill out our poll, our audience poll, and let us know who's in the audience. Maybe investors, maybe developers, lenders, brokers, property managers. We always like to know who's in the audience so we can gear our content in the future towards those individuals. All right, and as the poll wraps up, it looks like, as usual, about close to 50% of you are owners, investors. Then we do have our broker category that always comes in number 2. Other, not sure what the other is, but the other is pretty high today, about 19%. And then we have some lenders in the group. So wonderful. Thanks for being here. We really have put a lot of effort into making these more impactful, and we hope that you continue to attend and, of course, find that information at our LinkedIn or our YouTube channel. Okay, so now I'd like to introduce our speaker today, who we're delighted to have speaking on the topic of Proposition 19. Jordan Marks is our taxpayer advocate for the Office of Ernest J. Dronenberg Jr., San Diego County Assessor, Recorder, County Clerk. In his position, he assists taxpayers with navigating issues in the office and resolves over 1,000 taxpayer cases since joining the office in 2017. Thanks to the hard work of Jordan, San Diego taxpayers have received record high property savings in 2020, topping $236 million. Thank you, Jordan. We love saving on taxes. Jordan is a licensed attorney in California and was recently recognized by the San Diego Business Journal as one of their 2020 Next Top Business Leaders Under 40, giving us a detailed understanding of how the newly passed Proposition 19 will impact commercial real estate. Please welcome Jordan Marks. Jordan?
Thank you so much, Doug. I really appreciate it. And Paris and Ellen, and always good to be back with my friends at CCIM. What a wonderful organization. I'm going to take a moment here and share screen, and we're going to jump into a little PowerPoint that I put together to make it easy for you. All right. Get a thumbs up from Paris, and we're good to go if she can see the screen. All right. That sounds great. So what I was explaining to Paris and Doug before I got on, sounds like I could do pretty good work here at the office, but I can't put my new iPhone watch on silent. So I'm going to try to figure out how to turn it off again. Otherwise, I'll just throw it in the corner. It's the beauty of technology. Okay, but let's have fun, because today, while we love my iPhone watch, we want to talk about Prop 19. So as Doug said, I am Jordan Marks. I am your taxpayer advocate. I do work for Ernie Dronenberg. He's your elected assessor recorder clerk. Actually, in 2021, he was elected by the California Assessors Association as president of all the elected assessors. And that's going to come into our discussion today. I am the taxpayer advocate, and we're the only office in the state of California in an assessor's office that has a taxpayer advocate office to ensure fairness, provide education, and correct systemic issues. I only get to do a great job if I have exceptional partners like you and members of CCIM. So if you have ideas on how we could be better, we want to hear that information from you. We have 5 offices across the county, and I know some of you are like, well, that's great, but they're closed for over-the-counter services right now, and that is true. Unfortunately, due to COVID, the health officer has limited our ability to serve, and we cannot do it over the counter, but we are doing it via email. Somebody tried sending me a courier pigeon the other day. I chased it around. It wasn't very successful. I don't recommend that. But if you have an issue and we can walk something in, a recording that needs to be done that day, or I just had a map tax clearance that needed recording to move forward on a building project, whatever it is, call me. You're going to get my information at the end. That's the value of being a CCIM member, is you're going to get my cell phone, my email, and you're going to know that I appreciate Doug, Ellen, and the team. So let me know how we can help out during this kind of unusual time that we're in. So what does the assessor, recorder, county clerk do? Assessor, we appraise all real and personal property. Over 1 million parcels across the county. We do boats, planes, and once a year we get out and chase penguins around SeaWorld. It's kind of fun. Igloo appraisal is something interesting, but we're good at it. So we do that, but also we're the recorder. So birth certificates, death certificates, marriage certificates, and deeds. Yeah, I know you love it, because when a deed is recorded, that means a commission check gets cut. So we're happy to be a part of that process. And also we're the county clerk commissioner of civil marriages. Those are marriage licenses. If you got married in San Diego County, it likely has a name of Ernest J. Dronenberg on it. We issue about 25,000 of those annually, and we actually perform half the weddings on site. So as you think about how can Jordan and the office be assistants to you, make you a VIP, make you a rock star for your clients, if we can help out for them in a personal capacity or in a professional capacity in any way, let me know. You'd be amazed how many folks are like, well, my kid decided to get married and they forgot to get a license. Oh, let me call Jordan. We're going to try to help them through that. And that's what we're about. Great customer service is number one. We return money back to the county. We're a financial steward, over $3 million annually. We opened our offices to meet you where you live, and also we've moved more services online. We're doing less paper printing, 1 million pieces of paper less a year. not only are we the saving green assessor, we're also the going green assessor. Trees and money, that's what we care about. And then we've reduced your fees. We actually found a way that through our study that we were charging $2 for every property page of information. So if you got a property record, we're charging $2 a page. It's now $2 for the first page and $1.95 less, 5 cents for each additional page. So while $1.95 savings doesn't sound like a lot, if each part of government saved you $1.95, be $1,000 there. It's not quite winning the lottery, but it's pretty darn close. Also, we're the recorder, like I mentioned, and we've had record high recording. 2020 brought a lot, a pandemic, all sorts of stuff, to be honest. But what it also brought was refi madness. I know some of you are like, what did he just say? Reefer madness? Not reefer madness, sorry. That's a different side of the business. We don't do that. Refi madness. The rates are so low, it's great. And so we're basically in that same pipeline of recording documents. We're also recording all those refis. And so we did almost 1 million instrument recordings last year. This is going to come into our discussion. On average, we do 600,000 to 700,000. So this year alone, we're up 50% year over year on work. So refis are still going strong, and that's a part of the business. But our commitment to you as commercial realtors and folks in the real estate industry is we don't close until you do. It used to be if you got your recording in by 4 o'clock, we would close that and get it recorded that day. It's now 3 o'clock. We want to get our folks home by 9 o'clock. So just remember, you have to have it in by 3 o'clock. And, you know, some counties, they don't record for 3 days. If you go to LA, it's a 3-day recording process. San Diego, it's a 1-day process. That's our commitment to the serious work that you do and our support for you. So just an example of some of the things that we've been going through in our office. In 2020, the governor actually shut down all marriage services. And every county in the state of California closed down except for San Diego. Our boss challenged us, and Ernie said, how do we stay open? We have 1,700 couples. We need to honor our promise to them. So within 24 hours, we commandeered a snack shop outside our building, and we opened up the marriage hut. This is just an example. Our recording services come under these same pressures. We had an inauguration where they closed down part of our building and our offices. These are the things that come at us. So I would say, just as an example of this, we are resilient. We have not skipped a beat, but please leave an extra day or two in your transaction. We are in interesting times, and we're there to serve you, but help us and your transactions. Okay, so before we get into Prop 19, Prop 13 is something we have to dig into. And some of you are like, Prop 13, I thought that's old news. It is, but it's the basis of our property tax system. Prop 13, passed in 1978 by the voters, created an agreement between the property owner and the purchaser and the government that says when I buy a property, I can afford to pay 1% of that assessed value, or that's the purchase price in a fair and open market transaction, plus an up to 2% increase annually. So what does that look like? Well, let's say Paris goes out and buys a building for $100,000. 1% of that, you're running the numbers, that's $1,000. She commits that I can afford to pay that. And then it can go up to 2% of that amount per year, or it would be $20 increase for the next year. That is what makes our property tax system budgetable, affordable, and predictable. That is the foundation of California property taxes. Now, for some of you that are visual learners, let's say you have a house here, and it applies to commercial property, but you bought your property for $450,000, and boom, jumped up. You're up at $600,000 the next year, and we've seen that here in San Diego. If you were a property owner and you did not have the extra cash, you'd have a $1,500 property tax increase the next year. That's not affordable, but because of Prop 13's affordable, budgetable, and manageable predictability, you can then know, hey, you know what, it's going to cap at that black line and only go up 2%. Now, what came into the market was what happens if the properties go down. And I know every commercial realtor is like, no, it only goes up. It's California. Sometimes it goes down, right? And so if the market value drops below the assessed value, that's that 2% increase, we can actually reduce property taxes. And in 2010, we actually did that for 300,000 property owners. When the market dropped, we dropped their property taxes. Now, if you bought your home in 1978, you probably didn't see the market value go below assessed value. But if you bought your home in 2005, you did. But as it comes back up, you can see we'll return it with the market at that value, never to exceed that Prop 13 cap. That's that star on the screen. And so that's the protection of affordable, predictable, and budgetable property taxes. That's Prop 13 and Prop 8. Now you're smarter than 99% of the folks out there. Some of you are like, well, how do I find the assessed value on a building? Well, here's what you do. You call your title rep. Okay, that's the easy way. But let's say you're like, it's midnight. I'm looking up. I'm trying to get work done. The kids are asleep. You go to sdttc.com. That's the San Diego Treasurer Tax Collector. Dan McAllister's site. You go and pay the bill. Don't actually pay their bill, but you can punch in the APN or the address. And on there, you're going to see where I highlighted, that's the assessed value number. So for example, if this assessed value is $252,993, let's say about a $2,500 tax bill, it might be worth $1 million, but they're only paying that limited capped increase. So that's what you're looking for. That's the number you're going to work with. All right, we're done with Prop 13. Let's jump into Prop 19. The home protection for seniors, severely disabled families, wildfires, victims of natural disasters. I mean, they could have put unicorns and lollipops in this title. I mean, it has everything that you'd ever imagine would be good. Well, we're going to learn what actually is in Prop 19. Okay, Prop 19 impacted 4 areas of property taxes. 2 of them are going to be of concern to us today. One of them particularly impacting commercial property. And then 2 of them I just want you to know about. You're going to be really good for your clients. You're going to be super smart and be like, I got Jordan's cell phone number. If something happens, we're going to call him. The first one is the parent to child, grandparent to grandchild. Okay, so by the law under Prop 58, you as a parent can give to your kids the low assessed value on the property when you pass them the property. Also, the grandparent can give it to the grandchild. Now, some of you are like, why do we have a grandparent to grandchild and a parent to child? The law and the voters voted for this said, well, you can give it to the grandchild, but only if the parents passed. Now, I know some of you are like, I really love my grandkids. My kids, I can deal without them. Don't go killing your kids. It's a district attorney issue at that time, okay? What you have to do is you pass it to your kids and then give it to your grandkids. I've seen plenty of places where the grandparents gave it directly to the grandkids and they saw their taxes go up. The second one is the senior exclusion from reassessment. That's Prop 6090. And so that allows seniors to transfer over their property taxes to another primary residence. The other 2 that I want you to know about is Prop 110, that's severely and permanently disabled claimants. So on your primary residence, if you become severely or permanently disabled, let's say you get in a car accident, let's say you're coming back from Iraq or Afghanistan, and something happens where that 3-story building no longer works for you on your residence and you need to move into a ranch style home, we can help with that. In fact, we even had some guy out in East County, he was allergic to the dirt. I can't make this up. Got a doctor's documentation. Hey, if he lives there, he's going to be severely and permanently disabled due to his allergy from the dirt. We moved him to another part of the county. We made sure that their property taxes on their home didn't go up. The second part is disaster relief. So if a building is destroyed and it's your primary residence and it's a governor declared emergency, let's say that's a flood, fire, mudslides. If it's a natural disaster, I think last year during 2020, we were hitting biblical proportions of craziness. I think locusts may even fall into that category now. If the governor declares an emergency, you can go ahead and transfer your property tax base year rebuild without your taxes going up. So the interesting thing about Prop 19 is it made the disaster relief statewide. What we had before was we had a lot of properties that were being destroyed in areas like Butte County from the wildfires. Imagine the city of San Marcos burns down. It's crazy. Where are you going to go? People were going into their neighbors' backyards, and for $1,200 a night, they were renting a tarp and a twig, and it didn't work. It ran out of housing stock. A lot of folks came to San Diego County, and they were able to transfer their property taxes without being penalized. Okay, so now you know enough to be dangerous on the severely disabled and the natural disasters. If something happens, remember, call me. You got my cell phone and email at the end of the presentation. Also, I sent Ellen and Doug my slides, so they're going to send it to you too. So for those of you who are like, I'm writing feverishly, don't worry, you're going to get a copy of my slides. All right, so this is what just changed. Today is February 17th. As of February 16th, this new rule, Prop 19, went into effect for parent to child. Before February 16th, you got to give your kids unlimited value on the home. So no matter what the taxes, no matter what the value of the home, you can transfer that to your kids. They didn't have to live in the property, and you got $1 million of other assessed value. So for example, if you had a $2 million home or at a $20,000 tax bill at market value, and your property taxes were locked in at that low rate at $160,000 of assessed value or a $1,600 tax bill, you could give your kids your home and they would keep the $1,600 tax bill. That's a savings in this example of $18,400. Also, under the old rules, you got to give your kids commercial and secondary properties of assessed value up to $1 million. Remember, assessed value isn't the market value, it's the number on the tax bill. So for example, this was $500,000 when they bought it. Now, under the old rules, they can give them the $500,000 assessed value or a $5,000 tax bill. If they had a second condo with the same estimates, again, $500,000 for the condo, it's worth $1 million. You're saving them $5,000 a year. Under the new rules that just went into effect, now you're capped at $1 million of market value. Okay, notice I'm changing from assessed to market. $1 million of market value on the primary residence. Your kids have to live in the property. And you remember that $1 million of other that went to commercial and residential properties, second properties, that's gone. It got rid of it. So you have to also live in the home as primary residence, your kids do, within 1 year. And why did this take place? If you see my friend on the right, that's Jeff Bridges, AKA the dude from The Big Lebowski. And The Big Lebowski over here was living large up in Malibu. His parents, you might remember famous actor Lloyd Bridges, gave him a property in Malibu and a very low tax base. And that was his property they turned into a rental. It was worth $30 million or $300,000 a year, a tax bill at market. He was renting it out for $16,000 a month and only paying $5,000 a year in property taxes. He became the poster child for why they wanted to eliminate the commercial and secondary property values that we were able to pass down to the kids. So after February 16th, which starts yesterday, the dude must abide by the new rules. So you can just remember, thanks Jeff Bridges, thanks the dude, we got the new rules in place. So that same home, remember that you gave your kids that they were able to save $18,400 on? Now you have to take the assessed value and you add $1 million of market value to it. The difference between that and the current market value of the home is what's called the excess. And you add that to the old assessed value and that's your new bill. So I went to law school. I'm not a mathematician. Follow along. You should get there. You're going to have my slides so you can go back and look at the numbers. But the assessed value on this property is $160,000. You add that to the $1 million. That's what they give you of market value. So you're at 1.16, and you deduct that from this home that's now worth $2 million in the market. That excess is $840,000 of assessed value. Add that to the old 160. And boom, you got a $10,000 tax bill now versus you could have given your kids a $1,600 tax bill. Now, is that most of the properties out there? No, I'll show you what that looks like. But for the CCIM members, this is really important. That business lot, that second property rental value, it's gone. So if you own the property for your restaurant and it was assessed at $252,000 like that tax bill, but it's worth $1 million, it's going to go up. In this case, where you bought the property for $500,000 and now it's worth $1 million, the kids are going to see the tax bill double from $5,000 to $10,000. And that second condo in the example, again, if it was worth $1 million and they're paying based on $500,000, it would go up another $5,000. So the tax bill goes up. Why is this important to CCIM members? We think that 60% of the properties that were under this sort of transfer, they were using the other properties, are going to disappear now that Prop 19 has passed. That's going to impact your clients and their decision-making process. And so if you're aware of that and you're talking to your clients and their kids, which in most cases the seller, now you're building a relationship and you're having that discussion of the impact on them and what it looks like. I think you're going to see a lot more properties hit the market. And we're talking out of 7,000, we're going to see about 3,500 more that are going to be considered potential going into the market because the tax liability is going to be significant on some of these older properties. And so when you look at your farm and your area that you're researching and you're talking to your title rep and you're like, hey, give me the assessed values, you can say, well, I know the market values here. With these assessed values, I know that they're now probably going to want to sell because it's not as valuable a proposition with the tremendous tax increases on some of these older owned properties. Okay, remember we talked about that primary residence, the second home, or sorry, I apologize. This is your primary residence. This is one that your kids are going to move into. If you bought that home for $300,000, and this is what we think the average home in the market looks like, the assessed value goes up 2%. It's now $420,000, or at 1%, we're running the math, that's a $4,200 tax bill. If the market value is less than the assessed value plus $1 million, then the taxes stay the same when it transfers. So in this case, the market value on this home is now 1.3 million. And if you add assessed value plus $1 million, which is 1.42, if that's greater, which it is, the taxes remain the same. The difference is now the kids have to move into the property. They have to take it as their primary residence within a year. And we believe if they rent it out or use it or leave the property and don't maintain it as its primary residence, they're going to lose the benefit and it's going to get reassessed at the time that they received it. Now, I know some of you are kind of uncomfortable that you just heard the guy from the assessor's office use the word "we believe." It's a real issue. The initiative passed in November by the voters. The legislature has not acted fast enough to pass the rules associated with the implementation of Prop 19. We, as the administrator of the rules and the legislation, have not received those. We are working diligently. Remember, I told you Ernie is the president of the California Assessors Association. When I tell you we believe, it's because I'm reading the papers of what we're suggesting. I'm reading what the legislature is trying to do. I'm giving you a really good, educated guess because we are the tip of the spear on the implementation here. But the rules haven't been written yet, and nothing is concrete. What I'm telling you will be honored by our office in this process, but rules are subject to change. Okay. One other part, when they implemented Prop 19, they added this benefit for family farms. $1 million of market value for family farm property. So remember, you're getting $1 million for your home. Now you get $1 million above the assessed value for the farm property. So on this case, we have family farm, and it's worth the farm value. They're currently paying $10,000 of assessed value on $1 million, right? That's that 1%. Now, if the property is worth $3 million and you transfer that down, this is what it looks like. You take the assessed value, again, like the home, and you add $1 million, and then you deduct that from the market value, and that excess becomes the difference that you add on. So we had $1 million assessed value, that was the locked in low rate, and then you added $1 million to market value. That's what they gave you as a benefit to reduce the tax liability for family farmers. So that's $2 million minus the current market value of the total property, which is $3 million. That means you're adding $1 million on to the new tax bill. So the taxes for the parents was $1 million. Now, because of that difference of excess, you're adding another $1 million. The new tax bill is $2 million of assessed value, or $20,000. This is what it looks like. It's a way to save the family farm some money, and we can help walk you through that. Okay, here's my tips. If they changed ownership before February 15th, that includes somebody passing in that period, they're under the old rules. If it's after February 15th, you're under the new rules of 19. And you have to have a homeowner's exemption and a Prop 58, which is now Prop 19. The new form should be up today, of the parent to child transfer within 1 year, or you lose that benefit. All right, here's the biggest thing I'm gonna say. Consult your professionals. Anytime that I'm giving you advice on California property tax rules, I'm not your IRS professional. I'm not the guy that does your federal taxes, right? I'm talking about California property taxes. And when you move those properties and you sell them or gift them or whatever you want to do, it has federal income tax implications, capital gains tax implications. You have to consult your team, a state attorney, IRS professional. These are the folks that you should be thinking about as you're moving properties around, or your clients. Okay, after April 1st, we're going to have a change to what's called the senior transfer. I'm going to walk you through this real quick. The current rules are if you're over 55, okay, you're a senior. Not my definition, that's the government's definition, okay? I think 55 is very young. I'd never call it a senior, but we're going to go for this definition. 55, you get the senior qualification. One time on your primary residence, you can replace it with another primary residence under the formula cap. And the old formula cap that's going to go away after April 1st is sale price plus 5% in the first year or 10% in the second year. After that inflationary factor, it goes away because if you don't complete this deal within 2 years, you lose it. It has to be within the same county, that's Prop 60, or one of the other 11 counties that allows you to move into their counties and transfer your tax base. That's Prop 90. After April 1st, if you're over 55, still their definition of a senior, not mine, you get now 3 times. 3 times you can replace your primary residence. There's no more cap. So remember we talked about if you went above it, you didn't qualify. The cap's gone. If you go above the cap, we just add it at market rate and make it a blended assessment. You still have to do it within 2 years, and it's statewide now. So if you're trying to remember what county am I going into, it's statewide. Don't worry about it. So we have Paris. She did a great job. She bought her primary residence in 2000, paid $300,000 for it. It went up slowly to $420 or a $4,200 tax bill. And congrats, Paris sold her place for $1 million. That's awesome. And she's like, you know what, Jordan, I want to save some money. I want to take it and put it in the stock market. So she takes that $1 million sale price, that's her cap, and she went and bought a $900,000 home. If you take the $900,000 at market, you'd be paying $9,000 a year in taxes at 1%. But because it's below her sale price, we can transfer over the old tax bill of $4,200. That's what she'll pay, and she's going to save $4,800 a year. Congratulations, Paris. Great job. Now, Paris has been working super hard. She's gotten really good commissions this last year, had huge sales and releases. So she's like, you know what, Jordan, I need to go and get something bigger. I deserve it. Pamper myself. So same deal. She sold her home for $1 million, pays $4,200 in taxes, and she's like, I'm going to go get that place that's $1.2 million. I know some of you are running the math at 1%. That's a $12,000 tax bill if you bought it today. But because of Prop 19, you get to transfer over the old tax bill and add the difference at market. So what does that look like? You take the cap, which is $1 million here. You deduct, because that was her sale price. You deduct that from your purchase price, which was $1.2 million. The difference is $200,000 of assessed value. That's the excess. We add that onto the old assessed value, $620,000. Boom, that's her new bill, $6,200. $6,200 is $5,800 in savings off of what would be a $12,000 tax bill. Congratulations, Paris. Great move. Okay, here's some things I just want to talk about. We have a lot of folks that are like, I'm in between. I did my sale and now I want to do my purchase. I already sold. Can I still qualify? The answer is if it works under Prop 60 or 90, do the deal. Don't wait. But if you need to buy above the cap, remember that limit, then wait till after April 1st and do half the transaction then and you're going to qualify. 2, if you use any portion of your primary residence for a commercial property, some of you might be growing stuff. I'm not asking what it is, but if you use it for a commercial purpose, we're going to carve out that percentage of property and it won't count towards your primary residence. More likely is an example of you built an ADU in the back and it's 25% of the property. We'll take out that portion if you have a lease on it. You get 75% of your sale price towards the cap. That's your new cap. Now, let's say you rented it 5 years ago and you had a lease and now it's all primary residence. We're not going to carve it out. It's at the time of sale. Divorced couples used to fight over a lot of things, the teapot, the kids, the tax base. Well, you still got to work out who gets the tax base, but now it used to be because you only had one time to use your Prop 60 or 90. If somebody used it afterwards, the other person didn't get it. While the one person only gets to keep the base, the other person still gets multiple opportunities to do senior transfers. So that's a benefit now. Also, if you give it to your kids, you can't do a senior transfer. You gave it away. So you can do a parent to child, but then you can't do the senior transfers. You can do senior transfers 3 times and then give it to your kids. So just be aware of that. We had a realtor out of Los Angeles. They bought a home They were sold it for $3 million, and they were paying tax based on a $500,000 of assessed value or $5,000 tax bill. They came down to San Diego with their kids on title. They bought a $3 million home. She took the casita and back, hangs out with the grandkids every once in a while, and the family is saving $25,000 a year on property taxes because only one person is required to be over 55 on the purchase. And so you can bring your kids on with you to do that transfer. And remember, it's two deals in the residential market. You have to buy and sell or sell and buy. And if somebody wants to ask me a question about 1031 exchanges and senior transfers, we're going to jump into that a little bit. Here's something that I'm getting a lot of questions about. Remember Prop 8, in order for us to lower property taxes, it has to go below the assessed value. In the residential market, we're seeing this thing is going gangbusters, record high prices. We're not seeing any reductions, but in the commercial market for your clients, we did some modeling and we think if you purchased or had major renovations after 2015, you would be in a place to qualify for a property tax reduction, a Prop 8 form. We're going to be proactively mailing them out, but we're mailing them to people that we think would qualify. If you have a special case or it's something that we're not accounting for, contact us, let us know. And before April 30th, we want to get this resolved because we can make informal changes. After April 30th, it has to go to what's called an assessment appeals hearing. We don't want to do that when we can finish it informally. So if you have clients and go to your Rolodex and your past deals for the last couple of years and say, hey, have you talked to the assessor's office about getting your property taxes reduced? Now is the time. We had a comment on the homeowner's exemption for the parent-child after February 16th, which starts today. We have it online with e-signature. We're the only county in the state that offers that. We're really proud to be technologically advanced and meeting our taxpayers where they need the help. They have to file a homeowner's exemption if it's their primary residence. That's where it is on your tax bill. If you go look at your tax bill and you don't see the word homeowners and 7,000, you're not saving money. We want to help you. That's the mayor of Lemon Grove. She wasn't saving money. We helped her fill it out online a couple of years ago. She now gets she saved over $200. That's a nice steak dinner and a bottle of wine. So let's help you out and save your folks some money. The homeowner's exemption is based on primary residence, or there's a special one for disabled veterans in the state of California. If you are 100% VA rated, disabled, unemployable, or the surviving spouse of a disabled veteran that was 100% disabled or unemployable, we can save you some money. It's about $1,500 plus if your household income is less than $60,000. There's about another $680 we can save you. Just over $2,000. We're here to help out. We actually concentrated on perfecting our outreach to this community. When I started the Office of Taxpayer Advocate, it was in 2018, we had 5,000 disabled veterans who qualified. Today, with zero additional budget dollars and just a great partnership with the real estate community, we have over 11,000 disabled veterans qualified here in San Diego County. That's $16.5 million going back into the hands of veterans here in our county. So this is my contact information. You have my cell phone, you have my email, you have my boss's email. I'm going to put one caveat. My wife is a really good divorce attorney. And so when Prop19 was really in the thick of it, it's getting calls at 5 a.m., 6 a.m., 10 p.m. Some realtors work different hours. And I just say, hey, do me a favor. My wife has one request. After 8 a.m. or before 7 p.m., we have a 1 p.m. toddler, a 1-year-old toddler. And she said, if you don't get this and you take those calls, you're going to learn what I do for a living. I'd prefer not. Let's make my life easier. But I want to be accessible and I want to help you and your clients. So there's my contact information. And I know Ellen and Doug have it in the slides. Paris, are you ready to do a couple of Q&A? All right. I think Paris is coming back on. She may have hit the lodge. I'll tell you, we felt an avalanche here in our office from all the questions that we were getting on Prop 19. But let's jump in and see how we can be of help to the CCIM members and your clients.
Hi, Jordan. Are you able to hear me now?
I am.
Perfect. Sorry for that hiccup. So let's first go through the pre-submitted questions. I know, Jordan, you are keen to respond to those. So first question is, does this proposition impact 1031 tax exchange and how?
So here's something a bit of that our office has really been on the cutting edge. 1031 exchanges is an IRS provision that allows you on commercial property to transfer into another commercial property of like kind without having to report capital gains tax. It's deferred capital gains. Now, we have had some really interesting situations, and there is actually a way that somebody can turn their primary residence for a short period into a commercial use. They can lease it out. And some people believe, and that's not our expertise, this is you and your experts, that during that period it would count as a commercial property for 1031 exchanges. The rules on the senior transfer require on the primary residence that you identify it as your primary residence at the time that you file within 2 years. So we have had cases where folks on very large properties, talking about $3 to $5 million residences, where they sold it for that much, right? They had low tax bases and they had it as a commercial use, did a 1031 exchange and bought a place down here, and then claimed that as their primary residence and then transferred the low tax base under the senior transfer rules. That was a substantial saving of $30,000 for this one couple that we saw. Again, creative folks, smart exchangers, and great teams. I know I heard Bill Exeter, 1031 Exchange, is one of your supporters, a very smart person we've interacted with. Again, I'm not referring him, I'm just mentioning that based on my experience, you have smart exchangers in the San Diego community, and some of them are sponsors of today's event, like Bill Exeter, 1031 Exchanges. Talk to them, and they work through those issues. So yes, can there be an impact? Of course, because now you get to transfer 3 times versus 1 time. And so there are ways for you to advance your commercial portfolio of residential rentals in a way, but it's very limited in scope.
Thank you for that detailed answer. So the second one is, does a tenant in common vesting circumvent the negative issues associated with Proposition 19 transfer of investment real estate?
So I'm going to say they probably meant the joint tenants with right of survivorship. So if you take a property together, right, and you vest that joint tenancy prior to the February 16th date, that's the question that we usually get. In that capacity, we actually reassess when somebody dies. And so a joint tenancy does not circumvent a increase in the property taxes, even for commercial property. Because remember, if you did something and transferred it before February 16th, you got that benefit to the commercial properties. And so if you did do a joint tenancy, when the joint tenant dies and the other person takes 100% ownership, that becomes a reassessable event for our office, and unfortunately does not circumvent the rule change.
I see. Let's take the next one. So isn't there a February 15th deadline for the Proposition 19 actions? And wouldn't this seminar on the February 17th be considered a bit too late?
So information is really valuable, and your clients are going to be asking a lot of questions. So is it something where you lost an opportunity by having this seminar today versus doing it before February 17th? And the answer is no, because now you are more aware that we expect 60% of the transactions that would have been completed to now be considered something for a market opportunity. We do believe that there's a lot of folks that don't want to deal with these properties, but had the incentive been there to keep the property taxes low and had the voters not changed that, they would have kept the property. So based on our numbers, we're educating you and the members of CCIM that as you farm your market, as you look for opportunities, we think that that second generation is somebody you need to be in touch with. While you talk to your clients, start to get to know their kids, because their kids are likely to be the ones that are going to say, hey, you know what? I don't want to deal with this anymore. And they get usually a step up in basis for IRS tax purposes. So what that means is if your parents bought the property for $250,000 and it's worth $2 million, which we've seen, it happens, that means the kids would get if they got it as a gift, they would pay 1.75 million value for capital gains purposes, or 20% tax. But we think that there's going to be less incentive to hold the properties. And when you get a step up in basis, what that means is when somebody dies, your parent, that 250 purchase now goes to 2 million at market value, and the kids don't pay capital gains tax on that sales. Some of them are going to be looking to get out, and it's going to create more market transactions and opportunities. And so I think that's what we're talking today, is what is the opportunity going forward for CCIM members considering that new 19 rules?
Thanks for that explanation. I'm sure all of our guests today appreciate you very much for going through all those details with us. Last one. Do you foresee Proposition 19 impacting 1031 exchanges at will? Will this cause heirs to immediately sell instead of inherit or hold?
So I do think that, again, as I mentioned in the 1031 exchanges, it's very limited, but I actually think it opens up more opportunities to people that have a really good grasp of that niche ability on some of those really high-end properties, residential properties that are being used as rentals for a commercial purpose. For the second part, I do think, and as I mentioned, we're going to see more heirs wanting to sell the properties and liquidate assets because they don't have to pay capital gains taxes under the current rules. They got the step up in basis. Now, I know that the new President Biden and his administration has been eyeing eliminating the step up in basis. In addition, we're seeing a slim down of the of the gift estate. And so those things are going to be impacting whether people want to liquidate or potentially 1031 exchange out of the state and look for more other viable opportunities. But we do think that that conversation is going to be more prevalent. And because the benefit of keeping it here in California under the prior low property taxes is going to be eliminated, more people are going to be looking to liquidate or transfer their properties. That means more transactions for the CCIM members.
Sounds good. All right, we're going to start with our live questions now. This first question has a price attached to it. Our guest asks, if I lost a tenant and have a vacancy, can I provide a decrease in value of my property because of loss of income? Basically, can the income approach valuation to be used to dispute the assessed value for 2020 because of a loss of a tenant? And thank you for your time. I owe you a Bronx pizza. That's
good to see Chris, and I love a lot of the CCM members, and I look forward to the Bronx pizza. We had a little bet on the election, and it came very close, but it was actually on the passing of an initiative, and I appreciate that, Chris. So the answer is, it depends on your assessed value. Now, Chris, I happen to know, is a younger guy, so his assessed value on his property is probably not from 1978, but if he bought that property, and again, we think it's after 2015, and you can prove that there was a loss of value to property. I mean, if it's office space, we're seeing there is a depreciation of office space, and the market, you know, if we were to buy or use income approach to determine the value of a building and office space, it's lower today than it was in 2019. There's no question about that. If it's a movie theater, you know, if that's the tenant that you lost, that's a question. That's a good guess that there's going to be a great opportunity to help. A bowling alley. So in the case like Chris's, where he wants to explore this opportunity and say, hey, I just bought this property and now I have a lost tenant, and it's going to be harder for me to fill and rent at what my market value was when I determine the value of the building. File the Prop 8 form. We're going to get our team to sit with you. We're going to ask you for some financials from 19, 20, and then some forecasted numbers for 21. And remember, our lien date, that's the date that we go by for determining value, is January 1st, 2021. And so that's what we're looking at. What was the value on that date, and how do we account? And our team is working to be as taxpayer friendly as possible. We're looking for relief. Help us get there with the information that we need. And so that is seem like it may be a good opportunity there for you, Chris. And he has my email address. For everybody else, don't worry, it's in the slides. And we're going to work with you to help get tax relief for you and your clients.
All right. Another question from Chris is that why is there no real estate tax payment extensions for COVID relief? Are deadlines being pushed back? If not, why?
So from the treasurer tax collector side, the governor issued an executive order that did provide COVID relief for late payments and penalties. That was from April 2020 through April 2021. So if you missed your April 20th payment, you missed your December payment, you have to pay by April 2021. And there is some deferred relief there. There is an elimination of penalties. If you can show that it's COVID related, I'm happy to help walk anybody through that. And it's not the assessor's office, it's the other side of the house, but I call us peanut butter and jelly. You know, if we did our job separately, it wouldn't make sense, but it's a good sandwich together. And so we kind of try to partner and help each other out. We are waiting to see if the governor is going to issue an executive order to extend it into 2021. But to be honest, based on the collection rates and what we saw in 2020, they were still really high. It didn't seem like it was a tremendous push on the taxpayers. I do think that some of the forbearance issues will start to show up in 2021, but it's going to have to come as an executive order from the governor or something from the legislature. And just based on our recent Prop 19 experience in the legislature, we're just not seeing them move very quickly, and it doesn't seem like this is a priority. Remember, you're battling the school districts and the school unions, and payments in that, you know, deferred payments impact those sorts of school districts and special districts, fire districts. So there's a lot of pressure on the state through public employee unions to keep that piece in place and not defer property taxes, which is why even when it was passed in 2020, it was done almost literally after the deadline on April 2020. So I just don't have a lot of hope that we're going to see an extension of that, but it may be possible, especially considering the recall issues that the governor's facing, and he might be looking for goodwill in the community.
Thanks for shining a light on that. I'm sure a lot of us are wondering for the same question. So the next one asks, could you provide one more example considering commercial investment property?
So is that in regards to a 1031, or is that in regards to, okay, so
I believe that's with regard to Proposition 19.
So with the commercial property, again, before the old rules are assessed value. So if you bought a building and the assessed value is 100,000, okay, and the property is worth 10 million, you could give your kids, actually it's you and your spouse each would get a million each, could give your kids that $100,000 tax bill on a $10 million property. Let's say that ski lodge that Paris is in is worth 100 million, but they bought it in 1930, and so their taxes are 100,000 based on 100,000 assessed value, 1,000 a year. It doesn't matter if it's worth 30 or 300 million. They would keep the same low taxes. That is now gone starting yesterday.
I see. Thank you. The next question asks, if the child moved into his parents' property, would he be able to keep the lower assessed value?
So we're talking about the dude, I think, is the $30 million example. And so under the current rules, the answer is no. Well, what we do is we would take the assessed value and add $1 million of market value. And remember, the home's worth 30 million in the market, and they're paying a $5,000 tax bill or 500,000. So you take 500,000 of assessed value, add it to the million that the proposition gives you as far as extra leeway before you pay the increased taxes. That's 1.5 million. You deduct that from the 30 million, and all of a sudden you have a $28.5 million assessed value or a $285,000 tax bill. So the answer is the dude would be screwed. But let me tell you, that property would then go to a CCIM member because they have 30 acres of attached ranch on beachfront in Malibu. And I'm sure some of you would know what to do with that.
I'm sure. All right. The next question I'll ask, on a commercial property owned by 3 equal partners, if one dies, what happens to the property tax?
So it depends how it's held, but if it's, let's just say fee simple, a third each, we would reassess a third.
What if it's a joint tenant structure?
Yeah, so that percentage of ownership, when somebody dies, the joint tenancy is severed, and then that percentage becomes, again, a reassessable portion. So your ownership never changed, and so the taxes would stay the same, but the person that had their tenancy severed, even if you bought it out or had first right of refusal, any of that, that would be reassessed. Now, if the property is held in a corporation or some sort of corporate holding structure, an LLC, there are different rules that apply, because then we go to the 50% rule. And if it crosses over a 50% change of ownership, then it wouldn't, then it's reassessed. But if the third owner on a corporation died, then that would not trigger reassessment on that 1/3. It would only be when the majority of the corporation transfers, then it triggers 100% reassessment.
Got it.
And then I saw Pat's question on the bond assessments. Is it okay if I jump into that real quick, Paris?
Yes, of course.
So the bond assessments are based on assessed value of the property. So Prop 19 did not change that. What we will see, though, are higher assessed values, right? So remember, you got to transfer your kids or the commercial property at the lower assessed value. As the assessed value increases, so does the bond liability. And so if your bond was $100 for every 100,000 of assessed value, as your assessed value went up, and now it will on the commercial properties, so does the bond liability.
Great. The last question we have asked, how long would an ADU need to be not be leased for it to be considered non-commercial at time of sale?
We look at the time of sale. So, for example, you have some really great realtors out there that go into the MLS or into the different listing systems, and they're like, commercial use, we have a lease, you can do it. If that's there, that's what our folks are seeing. We use Google. It's very good, Google. And so, but it's at the time of sale. So for example, let's say 2 days, before you're going into the sale, and you're like, nope, that's now my garage or my poker room. That's what we go by. And, we would just, if there was a lease on the property, we would just need to look at that, and you could show us what the use is at the time of sale. And so just, I did see, it wasn't a question, but it was a comment from our good friend, Dave Malcolm. Thank you, Dave, for the shout out. I appreciate it. One of the legends of San Diego real estate. And so to get a compliment from him is a appreciated big deal. So.
Yeah. Well, I think that's a wrap for the Q&A session. And thank you for a very productive live Q&A session, Jordan. Back to you, Doug.
Well, thank you, Paris. And again, this isn't the end. This isn't the last bite at the apple. Because you're a great CCIM member, as I mentioned, Doug and Alan and Paris has said, we need your slides. We need your contact. Everybody has to have it. And so I'm sure they're going to get that to you. And it was on the presentation. And so I'm here to help you.
All right. Well, fantastic information. Thank you so much to our speaker, for our speaker today, Mr. Jordan Marks, taxpayers advocate at the San Diego County's Assessor's Office. Jordan, we really do appreciate you coming on and answering all these questions. A lot of information. Things are changing rapidly. Again, we will be providing Jordan's contact information with a replay link of this meeting. So if you had to step away and come back in, you will be able to rewatch it, and it will be provided via email. Any last minute pieces of advice, Jordan?
Well, we appreciate what you do moving the market, and anything we can do to make it easier, call early. Okay. I get a lot of foreign transactions with notarizations done in different languages. Those are walk-ins. Okay. Call us early. We're going to get you the information early. We'll check things out, so that way we can get you to closing and commissions.
Yeah, and David Malcolm hit the nail on the head. We do appreciate everything that you guys do over there. We couldn't close a transaction without the recorder's office. So thank you so much. We do appreciate it. And again, for CCIM San Diego, there are many ways to find our past and upcoming events. You can visit ccimsandiego.com. Of course, follow us on LinkedIn and subscribe to our YouTube channel. Believe it or not, we're getting a lot of videos over there from all these events. So take another look. Jordan will be on there next week. You can subscribe. You can rewatch his information. And then, of course, we are going to provide a copy of his slide deck. And that's all we have today. So for CCIM San Diego, I'm Doug Tabor. Until next time, hope you have a successful month, everybody. Take care.
See you next time. Bye.